A trader arrives at Lucid Trading and sees several possible roads. Pass an evaluation. Choose a different evaluation structure. Request access to payouts more frequently. Or skip the evaluation and enter a straight-to-funded program. On the surface, the destination appears simple. Get funded, earn payouts, move to Lucid Live, trade real capital. But those phrases do not all describe the same event. Lucid Trading's public website explains that its evaluations take place in a simulated environment. It also describes LucidDirect as a simulated straight-to-funded account. Traders may work toward real payments while their trading account itself remains simulated. And according to Lucid Trading's published live account rules, movement into a live brokerage account occurs later, after review by the company's risk team. That transition is not automatically created by passing. It is not automatically created by receiving funded status. And it is not necessarily created by receiving a payment from simulated account performance. So the central question is not merely whether Lucid Trading offers multiple paths to payouts. The question is, multiple paths to payouts, but when does live capital actually begin? This independent Sun Tzu Trading Company report will examine the full pathway presented through information readily available on Lucid Trading's own website, official help center, published program rules, payout policies, terms, and other public company materials. We will separate the major stages: purchase, evaluation or direct entry, simulated funded status, payout eligibility, withdrawal request, approval and payment, live transition review, and finally, entry into Lucid Live. Because each stage carries a different meaning. Passing is not payout. Funded is a status. Eligibility is a condition. Withdrawal is a request. Payment is the outcome. And for this company, one more distinction must be added. Payment from a simulated funded account is not necessarily the beginning of live capital. This report will ask whether Lucid Trading meets 4 golden rule standards. Does the company treat traders with respect? Does it provide clarity before they pay? Does it maintain consistent standards after they pass or enter a funded stage? And does it apply fairness when traders request payouts earned under its published rules? We will also examine what Lucid explains clearly, where its programs differ, which conditions require deeper verification, and whether the complete pathway is as understandable as the invitation to purchase. Sun Tzu Trading received no compensation from Lucid Trading for this report. There is no sponsorship, affiliate relationship, referral arrangement, paid placement, or promotional agreement. Lucid Trading did not review, approve, or control this report before publication. This assessment is based primarily on public information readily available through the company's website and official help center during the research period. It does not claim access to private company records. It does not claim that every trader receives the same outcome, and it does not predict whether any individual withdrawal request will be approved or paid. Program rules, prices, account structures, and company policies may change. Every trader should verify the current terms directly before purchasing. Our purpose is not to promote Lucid Trading. It is not to condemn Lucid Trading. It is to help the trader understand the road before paying to enter it. Preparation before prediction. Let us begin with the first task. Understand the road from purchase to payment and from simulated funding to live capital. To understand Lucid Trading, begin with the distinction the company makes in its own public materials. Its evaluation accounts are simulated. Its standard funded accounts, where traders work toward payouts, are also simulated. Actual brokerage capital begins later, when the trader is formally moved into a live program. That distinction matters because Lucid offers several paths. Lucid brokerage capital begins later, when the trader is formally moved into a live program. That distinction matters because Pro begins with a simulated evaluation. The trader must reach the profit target and satisfy the evaluation rules before becoming eligible to upgrade. After passing, the trader enters a LucidPro funded account. But Lucid describes that funded account as simulated. LucidFlex also begins with a simulated evaluation. After satisfying its profit target and consistency requirement, the trader becomes eligible for a simulated funded account. LucidDaily follows the same broad pattern, using its own profit target, consistency standard, and drawdown choices. LucidDirect removes the evaluation stage, but it does not remove the simulated stage. Lucid describes LucidDirect as a simulated, straight-to-funded account. The trader begins in the funded-style environment and works toward payouts without first passing an evaluation. Straight-to-funded does not mean straight-to-live capital. It means straight to a simulated funded account. From there, each program creates a different road to payout eligibility. LucidPro requires a minimum profit goal, a consistency percentage, and profit above a protected buffer. LucidFlex requires 5 qualifying profitable days and positive net profit during the payout cycle. It does not use the same payout buffer, but withdrawal amounts remain subject to program limits. LucidDirect requires a 20% consistency percentage and a payout profit goal. LucidDaily requires profit above its protected buffer and positive net profit since the previous withdrawal. These requirements are not interchangeable, and several reset after each approved payout. These are not 4 names for the same account. They are 4 different rule systems. A strategy may fit one pathway and conflict with another, even at the same advertised account size. Now follow the standard pathway carefully. First, the trader purchases a program. Second, the trader either completes an evaluation or enters LucidDirect without one. Third, the trader reaches a simulated funded stage. Fourth, the trader satisfies the payout requirements for that specific program. Fifth, the trader becomes eligible to submit a withdrawal request. Sixth, the request must be reviewed and approved. Only after approval is payment dispersed. That is why the complete doctrine matters. Passing is not payout. Funded is a status. Eligibility is a condition. Withdrawal is a request. Payment is the outcome. But even payment is not necessarily the final stage of Lucid Trading's pathway. A trader may receive real payments while continuing to trade simulated accounts. Movement to real brokerage capital comes later. According to Lucid Trading's current live structure, its risk team monitors simulated funded performance. Traders may enter the live review pool after reaching the final payout level on their plan, after receiving what Lucid considers significant lifetime payouts, after exceptional simulated performance, or after previously being moved live. But entering the review pool does not guarantee transition. Lucid states that all standard live transitions occur at the discretion of its risk team. There is also a separate pathway called Lucid Max. Lucid describes it as invite-only and unavailable to the general public. A trader must earn Lucid Max status through demonstrated performance. After passing that evaluation, the trader transitions directly into a live account. So Lucid Max is an important exception, but not a public shortcut available to a new buyer. For the standard public pathways, the dividing line remains clear. The evaluation is simulated. The funded payout stage is simulated. The payment may be real, but the trading capital becomes live only when Lucid formally moves the trader into Lucid Live or another expressly identified live program. This is the first major finding. Lucid Trading publishes a road toward real capital, but for its standard public programs, that road is not automatic. It is program dependent. It is performance dependent. And at the final gateway, it remains subject to company review and discretion. Next, we must look more closely at what changes when the trader crosses that gateway, and what happens to the simulated accounts left behind. What changes when Lucid Trading decides that a trader is ready for live capital? Under Lucid's current standard live structure, each eligible simulated funded account may become one Lucid Live account. But eligibility has an important condition. The funded account must have received at least one payout before it can qualify for the transition. When the trader is moved live, Lucid states that all remaining simulated prop accounts are closed. If a funded account is not moved because it has received no payouts, Lucid says the evaluation cost for that account will be refunded. This means a live transition is not merely the addition of another account. It can close the trader's remaining simulated account inventory. A trader keeping unused evaluations or simulated funded accounts in reserve must understand that consequence before the transition occurs. Moving live changes the entire operating environment. Under the current standard structure, Lucid Live accounts begin with a $0 account balance. But zero balance does not mean zero risk capacity. Lucid assigns a starting live drawdown according to the account size. The current published amounts range from $1,000 for a $25,000 account to $4,500 for a $150,000 account. Lucid Live provides daily payout access, an end-of-day drawdown, and no daily loss limit. The consistency requirements used in the simulated funded programs no longer apply after the trader is moved live. However, the trader does not necessarily receive immediate access to the maximum advertised contract size. Lucid's live scaling plan determines available size according to the account's profits, the account category, and the market being traded. As the balance rises or falls, the permitted contract size may also rise or fall at the end of the trading day. This creates another important distinction. The funded account size is a program label. The starting drawdown defines the immediate risk boundary, and the scaling plan determines how much size the trader may actually deploy. Those are three different measurements. The live drawdown also changes as the account grows. Lucid uses an end-of-day maximum loss limit. The limit follows the highest closing balance until the trader generates live profits equal to the assigned starting drawdown. At that point, the maximum loss limit locks at $100. Lucid also states that requesting a live payout before generating profits beyond that drawdown causes the limit to lock at $100. So daily payout access does not remove the need to understand what the withdrawal may do to the remaining account protection. For traders entering the standard live program for the first time, Lucid also publishes a possible one-time live bonus. The trader must generate a specified amount of live profit to qualify. The bonus is subject to the company's 90-10 split, is not available on later live transitions, and does not apply to Lucid Max traders. This is a potential benefit, not a substitute for understanding the drawdown or scaling structure. LucidDaily follows the same broad live account framework, but its transition contains additional conditions. The buffer accumulated in the simulated funded account is used to establish the starting live drawdown and cannot be withdrawn. Simulated profit above that buffer may be paid after broker verification and account approval, but Lucid publishes a total transition cap of $15,000. Any amount beyond that cap may not be withdrawn. Lucid daily transitions are processed after the final session report. Lucid says positions may be flattened when the accounts are paused and moved live. For the transition calculation, the company uses the prior day's closing balance. Profits or losses from the session in which the transition occurs are not counted. This policy is published, but it is financially material. A Lucid daily trader must understand that an active position may be closed and that the current session may not determine the balance used for the transition. Lucid Max remains different. It is not one of the standard public purchase options. It is an invite-only evaluation offered to traders selected through Lucid's performance review. After that evaluation is passed, the account begins with real capital. That is the clearest point in Lucid's public system, where passing itself leads directly to live trading. But access to that path must first be earned through the company's invitation process. The complete answer to our central question is now visible. For LucidPro, LucidFlex, LucidDirect, and LucidDaily, live capital begins only after Lucid's risk team approves and completes the transition into Lucid Live. Not at purchase, not after an evaluation is passed, not when simulated funded status begins, not when payout eligibility is reached, and not necessarily when the trader receives a payment. Live capital begins when the account itself is formally placed into a live brokerage environment. Lucid Trading explains this pathway through its public help center. But the trader must assemble the complete meaning across program rules, payout rules, live transition rules, and scaling rules. That completes the first mission. Understand the pathway. Next, we must measure what each pathway demands before the trader reaches the first payment, and before the possibility of live capital becomes relevant. Understanding the pathway is only the beginning. Now the trader must measure the true commitment required before the first payment. That commitment is not defined by the advertised account size. A $50,000 account is not $50,000 of personal risk capital. The practical operating boundary is the amount the trader may lose before the account is breached. At Lucid Trading, that boundary is the maximum loss limit. For most public plans, the published limits range from $1,000 on a $25,000 account to $4,500 on a $150,000 account. LucidDirect is different at the larger sizes. Its published limit rises to $3,500 on the $100,000 account and $5,000 on the $150,000 account. Do not choose an account by the number in its name. Choose it by the drawdown, daily restrictions, payout requirements, and position size your strategy can survive. Begin with LucidPro. The evaluation profit targets run from $1,250 to $9,000, depending on account size. The evaluation may be passed in one trading day, with no monthly rebilling or activation fee. But reaching the target is only the evaluation commitment. After passing, the trader enters a simulated funded account. To reach the first payout, the trader must produce the required cycle profit, keep the largest winning day within the 40% consistency standard, build profit above the protected buffer, and request at least $500. The buffer equals the initial maximum loss limit, plus $100. The trader cannot withdraw the capital Lucid designates as the account size. The evaluation may be passed in one trading day, with no monthly rebilling or activation fee. But reaching the target is only the evaluation commitment. After passing, the trader enters a simulated funded account. To reach the first payout, the trader must produce the required cycle profit, keep the largest winning day within the 40% consistency standard, build profit above the protected buffer, and request at least $500. The buffer equals the initial maximum safety layer, and if trading after the request drops the balance into that buffer before approval, the withdrawal may be denied. LucidPro may fit a trader who wants immediate access to the full published contract limit and can trade within a daily loss restriction on the larger account sizes. But the strategy must also produce profits in a pattern that satisfies the consistency calculation. One unusually large day can delay eligibility until additional profit reduces that day's percentage of the total. Now measure LucidFlex. Its evaluation uses the same broad profit target and maximum loss limit ranges, but adds a 50% consistency requirement before upgrade. There is no daily loss limit in the evaluation. In the simulated funded stage, LucidFlex removes the daily loss limit, removes payout consistency, and does not require a protected payout buffer. But the commitment moves elsewhere. The trader must produce 5 separate qualifying profitable days during every payout cycle, plus positive net profit for the cycle. The required daily profit ranges from $100 to $250, depending on account size. The trader may request only 50% of account profit, subject to the program's dollar cap. And the funded account uses a scaling plan. The trader does not begin with the full advertised contract size. Available size rises or falls with simulated profit and may move downward after a payout reduces the balance. LucidFlex removes some restrictions. It replaces them with qualifying days, withdrawal limits, and dynamic position sizing. Now consider LucidDirect. LucidDirect removes the evaluation, but not the performance burden. The trader begins immediately in a simulated funded account. For the first payout, the published profit goals range from $1,500 to $9,000. The largest winning day must remain at or below 20% of total cycle profit. That is the strictest published payout consistency percentage among Lucid's standard public programs. The rule resets after every approved payout. So the trader is paying to remove the evaluation stage, not to remove the need for disciplined, distributed profitability. The fastest entry may not create the shortest road to payment. A trader must compare the rule structure with the actual behavior of the strategy. How often does it trade? How concentrated are its best days? How much drawdown does it normally require? Can it produce 5 qualifying days? Can it remain below a 20% or 40% consistency threshold? And can it continue after a withdrawal without exposing the account to immediate breach? Those questions matter more than the size printed on the account. Next, we will measure LucidDaily, the cost of resets and failed attempts, the time commitment, and the operational conditions that can affect whether the trader reaches the first payment. Now measure LucidDaily. Its evaluation uses a 50% consistency requirement. The trader may choose an intraday or end-of-day drawdown. After passing, The trader enters a simulated funded account with no payout consistency rule and access to daily withdrawal requests once eligible. But daily access does not mean every trading day produces a payable balance. The trader must first build profit above the protected buffer. That buffer equals the initial maximum loss limit plus $100, and it cannot be withdrawn. The trader must also show positive net profit since the previous approved payout. The minimum request is $500. There is no fixed payout window, and the maximum request is the simulated profit accumulated above the buffer. LucidDaily also sets a maximum amount of simulated profit that may be earned in one day. The threshold depends on account size. Reaching or exceeding it causes the account to enter the live transition process. The trader must therefore understand the transition rules examined earlier, including the buffer, transition cap, and possibility that positions may be flattened. The most important operational difference is scheduled news. On LucidDaily, trading through designated red folder news is prohibited and treated as a hard breach. The trader must be flat from 1 minute before the event until 1 minute after it. News trading is permitted on LucidPro, LucidFlex, and LucidDirect. A strategy built around economic releases may fit one pathway and immediately conflict with another. Now measure the financial commitment beyond the first purchase. Lucid uses one-time fees rather than automatic monthly rebilling for its standard simulated programs. There is no activation fee when an eligible evaluation is upgraded. But a failed evaluation does not restart automatically. To begin again, the trader must purchase a reset or another account. A reset returns the evaluation to its original balance and risk conditions, but its cost becomes part of the total commitment. The true cost is not the price of one account. It is the sum of every purchase, reset, failed attempt, related expense, and hour committed before money is received. A low entry price can become expensive when the trader repeatedly re-enters without correcting the reason for failure. Measure total money spent before the first payment, not merely the price beside the buy button. Time must also be measured. The one-time fee structure removes a monthly renewal deadline, and Lucid says traders may take as long as needed to pass its current evaluations. But the strategy still determines the time required. LucidFlex requires 5 qualifying profitable days during each payout cycle. LucidPro and LucidDirect consistency rules may require additional trading after the nominal profit goal is reached. LucidDaily requires navigation around scheduled news restrictions, and every payout request remains exposed to account activity until approval. If continued trading drops the balance below the applicable buffer or profit requirement, the request may be denied. A withdrawal request is final once submitted. It cannot be edited or canceled. Once approved, Lucid says funds are deducted from the trading account within minutes and dispersed through the selected payment method within 2 business days. Available methods differ by location, but those methods matter only after eligibility, submission, review, and approval. The trader must also protect the account from inactivity. Lucid states that an account with no trade producing at least $1 of net profit or loss during 30 calendar days may be treated as abandoned and permanently deleted. A breached evaluation may remain eligible for reset, but Lucid says breached accounts are also deleted after 30 days if no reset is purchased. The measurement is now complete. LucidPro emphasizes buffer protection and 40% payout consistency. LucidFlex removes the payout buffer and consistency rule, but requires 5 qualifying days, limited withdrawals, and scaled position size. LucidDirect removes the evaluation but imposes demanding profit goals and 20% payout consistency. LucidDaily offers daily requests and no funded stage consistency rule, but retains the buffer and adds a strict news restriction and automatic live transition threshold. The best pathway is not the one that sounds fastest. It is the one whose drawdown, payout rules, trading day requirements, restrictions, and total cost match the trader's actual strategy and discipline. That completes the second mission. Measure the commitment before the first payment. Next, we will decide which type of trader may realistically fit each pathway and where caution remains necessary. We have understood the pathway. We have measured the commitment. The trader must decide which pathway, if any, matches the way the trader actually performs. This is a compatibility decision, not a ranking. Begin with the trader whose strongest days are much larger than the rest. What if one session regularly produces half of total profit? LucidPro may become difficult because the largest winning day must remain within 40% of payout cycle profit. LucidDirect may become even more difficult because its threshold is 20%. The account may be profitable and still remain ineligible until additional profit reduces the influence of that largest day. LucidFlex or LucidDaily may appear more compatible because their funded stage payout rules do not use that consistency percentage. But each replaces that rule with different conditions. LucidFlex requires 5 qualifying profitable days during every payout cycle and limits each request to 50% of profit, subject to the account cap. LucidDaily preserves a protected buffer and adds program-specific operating restrictions. Now consider the low-frequency trader. What if the strategy produces only 1 or 2 quality setups each week? LucidFlex may not be the simplest fit. The trader must still produce 5 separate qualifying profitable days before each request. A strategy that waits for rare setups may need more calendar time than the purchase page suggests. LucidPro or LucidDirect do not require 5 qualifying days, but their consistency rules can still require profit to be distributed across multiple sessions. No fixed payout window means no guaranteed speed. The strategy creates the real timeline. Now consider the trader who wants to trade major economic releases. LucidDaily presents a direct conflict. Its published rules prohibit trading through designated red folder news events and require the trader to remain flat around the restricted period. LucidPro, LucidFlex, and LucidDirect currently permit news trading. But permission is not protection. The trader must still remain within the maximum loss limit, any applicable daily loss limit, and every other account rule. Test a volatility strategy against those boundaries before purchase. Now consider the trader who dislikes daily loss limits. LucidFlex does not use a funded stage daily loss limit. LucidPro and LucidDaily can now be purchased with the daily loss limit turned on or off. The choice affects price, applies to both the evaluation and funded stages, and cannot be changed on an active account. LucidDirect uses a daily loss limit on most account sizes. Lucid describes it as a soft breach when the maximum loss limit remains intact. The decision is not simply whether a daily loss limit exists. It is whether the trader benefits from a daily stop or fights it. Now consider the trader who values the simplest entry. LucidDirect removes the evaluation. That may reduce 1 layer of time before funded status, but it begins immediately inside a simulated funded rule set with a 20% payout consistency requirement. The trader must decide whether direct entry solves a strategic problem or merely satisfies the desire to feel funded sooner. Straight to funded is not straight to payment, and it is not straight to live capital. Now consider the trader who prefers a protected reserve. LucidPro and LucidDaily require profit above a buffer before a withdrawal may be requested. That reserve may protect the account after payment, but part of the balance remains unavailable. LucidFlex has no payout buffer, yet limits the request through its 50% rule and fixed dollar caps. The trader must decide which restriction is easier to manage: capital that must remain protected, or profit that cannot all be requested at once. Every pathway solves one problem by introducing another condition. LucidPro offers a structured payout pathway, but requires buffer protection and 40% consistency. LucidFlex removes the payout buffer and funded stage consistency rule, but requires 5 qualifying days, limited withdrawals, and scaled position size. LucidDirect removes the evaluation, but retains simulated funding, profit objectives, and 20% consistency. LucidDaily offers daily request access once eligible and customizable loss settings, but retains the buffer, uses an intraday drawdown in the funded stage, restricts designated news trading, and can trigger a live transition when the published daily profit threshold is reached. The correct question is not, which account sounds most generous? It is, which rule set can your documented strategy follow without forcing you to trade differently merely to satisfy the program? Next, we will apply this framework to new traders, experienced traders, payout-focused traders, and those seeking live capital. Now apply the framework to the trader, not merely the account. Begin with the new trader. What if the trader has not yet documented how often the strategy wins, how profits are distributed, or how it behaves near the drawdown boundary? In that case, the most flexible pathway may not be the easiest pathway. LucidDaily asks the buyer to choose loss limit and evaluation drawdown settings before trading begins. LucidDirect removes the evaluation, but it also removes the chance to prove compatibility before entering the simulated funded rule set. LucidFlex removes several funded stage restrictions, yet still requires 5 qualifying profitable days before every payout request. LucidPro provides a more structured progression, but the trader must manage its profit goal, buffer, consistency percentage, and selected loss limit setting. A new trader should not confuse fewer stages with fewer decisions. Before purchase, the trader should be able to describe the exact rule that ends the account, the exact conditions that create payout eligibility, and the behavior that could delay a request. If those answers are unclear, the pathway has not yet been understood well enough to buy. Now consider the experienced trader. What if the trader already has a documented record across dozens or hundreds of sessions? That trader can test compatibility with evidence. Measure how often the largest winning day exceeds 20 or 40% of cycle profit. Count how frequently the strategy produces 5 separate qualifying days. Review how often open profit retreats far enough to threaten an intraday drawdown. Identify whether designated news events are essential to the strategy. Then model what remains after a payout, not only what may be requested. Experience becomes useful only when it is translated into the language of the program. A profitable strategy can still be incompatible with the wrong consistency rule, withdrawal structure, drawdown method, or trading restriction. Now consider the payout-focused trader. What if the primary objective is to receive money as regularly as possible? No fixed payout window allows a request after eligibility is satisfied. It does not establish how quickly the trader will create that eligibility again. LucidPro and LucidDirect reset cycle objectives after an approved payout. LucidFlex requires 5 new qualifying profitable days and limits each request. LucidDaily permits daily requests once eligible, but the buffer remains protected and positive net profit must be produced between requests. The trader must calculate the full repeatable cycle: profit required, profit unavailable, maximum request, rules that reset, and the trading time needed to qualify again. The first payout is not enough to prove that the pathway is sustainable. The repeatable payout cycle is the real test. Finally, consider the trader whose primary objective is live capital. What if the trader is willing to accept smaller or delayed simulated payouts in exchange for reaching a real brokerage account? That decision requires the greatest caution. Lucid standard pathways begin in evaluation or simulated funded environments. Live capital does not begin when the evaluation is passed. It does not begin when funded status appears, and it does not automatically begin with the first payout. Under Lucid's current published structure, a trader may enter live review after the final simulated payout level, after significant lifetime payouts, through exceptional performance, or through other risk team criteria. But the transition remains discretionary. Even payout 5 is described as a review point, not a guaranteed date for live capital. So when does live capital actually begin? Only when Lucid approves the transition and the trader's live brokerage account is established. Until that event occurs, the trader is progressing toward live consideration, not trading live capital. That distinction governs the final decision. Do not purchase a simulated pathway because the destination is described as live. Purchase only when the rules before that destination are acceptable on their own. We can now deliver the final assessment: what Lucid Trading should clarify, what new traders should verify, and what experienced traders should measure before moving forward. We have reached the final assessment. Lucid Trading is not one pathway. It is a group of programs using different combinations of evaluation structure, drawdown, consistency, payout eligibility, withdrawal limits, and access to live review. Our classification is Consider, with program-specific verification. This is not an endorsement of every Lucid program. It means Lucid publishes enough of the pathway for a prepared trader to examine the opportunity, but the decision must be made one program at a time. First, our recommendation to Lucid Trading. Lucid has expanded trader choice. LucidPro and LucidDaily now allow the buyer to select whether a daily loss limit will apply. LucidDaily also allows the trader to choose the evaluation drawdown method. LucidFlex removes several funded stage restrictions. LucidDirect offers entry without an evaluation. Choice can be valuable, but more choice creates a greater responsibility to make every pathway easy to compare before purchase. Lucid should publish one permanent version-dated comparison showing, for every active program, the evaluation structure, the funded account type, the drawdown method, the daily loss limit, the consistency requirement, the payout buffer, the qualifying day requirement, the maximum request, what resets after payment, and the route into live review. The trader should not have to reconstruct the pathway across multiple pages. Lucid should also distinguish more prominently between simulated funded status, payout eligibility, and approved withdrawal, payment received, entry into live review, and establishment of a live brokerage account. Lucid's risk team retains discretion over live transitions. That may be necessary for risk management, but a review point should never sound like a guaranteed transition date. When a material rule changes, Lucid should preserve a visible effective date and identify which accounts follow the new version. Clear version control protects the trader and the company. Now, our recommendation to new traders. Do not begin by asking which Lucid account is cheapest, fastest, or largest. Select one program and write its complete pathway in your own words. You should be able to answer, what ends the account? What creates funded status? What creates payout eligibility? How much may be requested? What must remain in the account? What resets after payment? And what event places the trader into live review? If any answer depends on an assumption, stop and verify it with Lucid before purchase. New traders should be cautious with direct-to-funded language, customizable settings, and daily payout access. Each feature may remove one restriction while introducing another decision that must be made correctly before trading begins. A new trader should consider Lucid only after the exact program can be explained without relying on the headline. Until then, the appropriate decision is to wait. Now, our recommendation to experienced traders. Lucid may deserve consideration when the trader has enough performance data to test a specific program against actual behavior. Use your records. Measure the largest winning day as a percentage of cycle profit. Count qualifying profitable days. Model the buffer or payout cap. Test the exact drawdown method. Identify whether news restrictions remove essential trades. And calculate the repeatable pathway from one payment to the next. Experienced traders seeking live capital should treat live access as a possible later outcome, not as the product being purchased today. The product purchased today is the specific evaluation or simulated funded pathway, governed by its rules and Lucid's continuing risk oversight. That pathway must remain acceptable even if live approval comes later than expected, or does not come at all. Our final finding is balanced. Lucid Trading publishes multiple routes toward payouts and possible live capital. It also requires the trader to navigate program-specific rules, changing configurations, repeatable payout conditions, and a discretionary live transition that cannot be fully measured before purchase. The final classification remains consider with program-specific verification. Passing is not payout. Funded is a status. Eligibility is a condition. Withdrawal is a request. Payment is the outcome. And live capital begins only when the transition is approved and the brokerage account is established. Search the exact program. Verify the exact rules. Then decide whether the complete pathway, not merely the promise at the end, fits the trader you have already proven yourself to be. Continue your independent research at suntrading.com. Choose search prop firms. Review the available research. Understand the rules. Measure the complete commitment. And verify the pathway before you pay. Subscribe to Sun Tzu Trading at Sun Tzu Trading for independent market intelligence reports, war room briefings, prop firm battlefield reports, the prop firm manifesto, and educational field guides designed to help you prepare before entering the market. The firm controls its program, but the trader controls the decision to enter it. Search before you select. Trust, but verify. Preparation before prediction. A special message to prop firms. The prop firm industry stands at the threshold of major change. New companies are entering the market. Competition is intensifying, and firms are fighting every day for the attention, confidence, and market share of traders. Not every company will survive. The firms that endure will be those with the strongest business practices, the clearest rules, reliable payout systems, and the highest ethical standards. Traders should not be treated as customers to be recycled through an endless evaluation hamster wheel. Their time, their money, their discipline, and their trust sustain this industry. Show them the complete pathway, from purchasing an evaluation to receiving a payout. Treat them with respect. Give them clarity before they pay, consistency after they pass, and fairness when they request the payout they have earned under your rules. The prop firms that do so will earn something no discount and no promotion can purchase: the respect, confidence, and long-term loyalty of their traders. Transparency does not weaken the prop firm industry. It strengthens it.